Lower borrowing costs and cheaper loans could be coming to the Gulf. Here's why. The Federal Reserve, which controls interest rates in the United States, is almost certainly going to reduce its main rate on Wednesday for the first time in more than 4 years. That's after significantly raising it in 2022 and 2023 to combat rampant inflation in the aftermath of the COVID-19 pandemic, as financial measures were taken to keep economies afloat. But now, those high rates have taken effect and brought inflation back down, giving the Fed some breathing room to ease measures. So what does that have to do with the Middle East? Well, most Gulf currencies are pegged to the US dollar. That helps give them monetary stability with less risk and avoid sharp increases in the costs of goods. But it also means central banks here follow what the Fed does. So if the Fed lowers interest rates, so do Gulf countries. That leads to lower borrowing costs and could boost business and consumer spending in the region, encourage people to take out mortgage loans, and relieve some pressure on those who already have debt. A cut from the Fed will also likely weaken the dollar, making US assets less attractive and potentially redirecting investments toward emerging markets, like those in the Middle East. It also affects oil prices, impacting how much you spend at the pump. When the dollar is weak, oil prices typically rise, and vice versa. And Wednesday's cut is likely to be the start of an easing cycle, with further reductions anticipated to the end of the year and likely into 2025.